This is Daniela Cambone for Kitco News, and I'm at the U.S. Gold headquarters in Toronto. Joining me is Rob McEwen. He's the CEO and chairman of U.S. Gold and Minera Andes. We're here to talk about the proposed merger of both companies, the price of gold, where is it headed, and of course, the state of the junior mining sector. Rob, thank you so much for joining us today.
Pleasure to be here, Daniela.
Rob, I guess my first question to you is why? Why did you decide to propose the merger of U.S. Gold with Minera Andes? What are the benefits?
I thought it made a lot of sense to put the two together. It creates a company with larger critical mass, so it should attract greater research and more of a following in the market. It takes the assets, the producing assets of Minera, which are passive and discounted in the market, and Minera doesn't have a pipeline of development projects, and combines it with the development projects of U.S. Gold that doesn't have the income stream. So it's a very neat merging of the strengths. And with the prices of the metals where they were last year, you could see basically fully funding that pipeline of development through that cash flow and get a multiple expansion on the company. You'd have better liquidity, better balance sheet, and diversification through the Americas. So in America, Mexico, Argentina, so it diversifies the risk that Minera has, broadens the reach of U.S. Gold, and then there are a number of exploration projects that are quite exciting in both companies, and together I think it makes a much stronger story.
Rob, let's talk about the price of gold. This is the most popular question I receive from you viewers is where is it headed? Now, last year, many analysts had predicted $2,000 gold by year end. We didn't quite get there. We were close. But why do you think we didn't hit that mark?
Problems with the euro. I think there was a great rush to liquidity. People were caught off guard that the euro was falling apart. They'd made a bet earlier on that the dollar was going down and the euro was going to be the successor currency. When that didn't work, people were looking for liquidity. Gold, as you know, has been up every year for the last 11 years. So there are large profits in gold and in gold shares. And I think there was just a liquidation. It's easier to sell your winners than your losers. And they just started hitting the market hard. I think it's an anomaly, and you've already started to see a recovery this year. People they're looking at the euro and saying, well, maybe the European Union's resolved their differences, or maybe America's economy is getting better. It's improved a bit, but considering the trillions of dollars that have been pumped into the economy, it should be flying right now.
But the U.S. had some strong jobs data coming out last week, Rob, with 200,000 new jobs created in December.
That's promising. You have to look at the numbers and wonder if they're real or not. Say the consumer price index. In that calculation, they don't include food or energy costs. And those are probably two of the big drivers of inflation. In the unemployment, with the money that's gone in, you would expect there'd be some improvement there.
So, Rob, if you had to choose between the U.S. dollar, the Fed, and the euro, which would you say has the greatest impact on the price of gold?
I'd say all three would make a contribution. The Fed and the monetary easing will have the biggest long-term impact on the price of gold as they continue to try to kickstart the economy with massive injections of additional funds.
Rob, a recent survey of LBMA delegates forecasted 1766 gold for 2012. What do you think of that forecast?
That's an average. So is it going to swing $500 either side? So you'd be at 2,200 and down to 1,200? Because it's an average. Right. I think it's going to go through 2,000, cleanly through 2,000 this year, on its way to 5,000 several years out.
Rob, let's go back to the merger for a second. Before, you were CEO of Goldcorp, and during your time there, you really built it from a series of small companies into a mining powerhouse. Is this the same strategy you're looking to repeat?
Absolutely. In Goldcorp, just visiting that for a moment, I saw what I thought was an undervalued company, and that could be enhanced by putting it together with others. So over the course of 8 years, I took 5 companies and through 3 corporate restructurings, created Goldcorp. And I thought with US Gold and Minera Andes, we're looking at a similar situation where the junior mining sector, we've seen a proliferation of stocks to the point that it's confusing for investors to figure out which stock to invest in. So it's essential, I believe, for companies to get larger, to have the mass that will encourage analysts to follow them, that will give them the presence in the market to allow investors to be interested. Because right now it's a question of too much choice. If I gave you 2 glasses of water, one was blue and one was green, and say, which one would you like? You'd pick one. But if I gave you 16 and they were all different colors and all different sizes, you'd have to think, well, maybe I'll think about that. I'm not sure. I like that color, but don't like the glass. And that creates the hesitation in the investor. So we have this broad array of junior companies, and the market's looking at them and saying right now, how are they going to finance their future exploration? They're going to have to go back to the market, issue stock at a much lower price, and that means my interest is being diluted. So by getting larger, you have a better chance of raising capital at a lower cost and using that as a springboard to run for our goal of qualifying for inclusion in the S&P 500 during 2015.
So what was the secret behind the success of Goldcorp?
Special sauce. For Goldcorp, it was looking at an asset that most people thought was going to close. When I bought into it, I'd watched the company, and it had been starved of capital for about 15 years, and had bad labor practices, bad labor relations, not practices. So most people, when I bought into that company, went, why would you buy that? But one of the richest mines was right next door, and you could get it for a low price. Then you looked at, well, there was a labor problem, there was a debt equity ratio of 1 to 1, and they hadn't done any exploration for more than 10 years. So I thought, that's strange. You have a very rich deposit right next door. It's thought they're part of the same deposit, just 2 different owners. So I said, let's put money into exploration once we've eradicated the debt and step up the exploration. And so Goldcorp started that way. So you get rid of the debt, you tighten up the board of directors, you get on another exchange. We're on Toronto, and then we listed on the Amex, and then listed on New York. So just increasing the credibility of the company, and then bringing in technologies that were used in other industries to see if we could employ them in the mining industry to our advantage, which occurred.
What's happening with the junior mining stocks? What are your thoughts on this sector?
You should buy them. They've been heavily oversold. They may stay there for a little bit, but they will either be subject to consolidation amongst themselves, and the majors will reach down. And so in both those cases, you probably have a lifting of value.
What should investors be looking for when they're choosing a junior mining stock?
Well, one thing that I think is very important is the amount of money that senior management have invested in the company. On the merged company, I'll own 25% of the company. I have $110 million invested that I bought my stock, and it's worth about $250 million today. So I'm a little in the money on that. I'd like to see it grow considerably from where it is today. So I think if you look at a lot of companies, senior management can frequently have very small investments in the company, and they'll rely on salaries and options to make all their money. And sometimes that goes to the detriment of the shareholder. If I look at my former company, Goldcorp, when I bought Wheaton River in 2005, I said to our shareholders, I expect our shares to double or triple in price in a 12-month period from the purchase. It took 14 months for it to triple, so I was 2 months off. But it tripled, and it was trading at $44 a share. And if you look at it today, it's only a few dollars above that. And you say, now wait a minute, the price of gold has gone up about 130% since then, and they've doubled their gold production. How come they're up 10 or 15%? Doesn't make any sense at all. But management didn't have any investment, and they bought a company. They issued 80% of the company to buy Glamis. Now, I'm not just picking on Goldcorp, but you can look at some of the decisions by management in the large companies have cost their shareholders dearly. You can look at Barrick. In the last 15 years, it's tripled its production. It's producing about 8 million ounces of gold today. And during that period, the price of gold has gone up more than fivefold, and they've tripled their production. So you go, all right, price of gold's up and they've tripled production. Should they be up 15 times? They're only up 3 times. And you say, well, what happened? Kinross went out and bought a gold property in Africa, right, and saw their share price, just the whole purchase price, the $7 billion, was taken out of their stock. And Barrick recently bought a copper project. It might be good for generating earnings when the stock's trading close to a net asset value, but people didn't buy it for copper. Now, if they're going to use the copper stream and pay a big dividend, then maybe the shareholders will like that. But I just think that the seniors, whether it's management risk, the decisions they're making that are penalizing the shareholders, could be the countries they're in that are increasing the taxes, or the cost of development is much higher. But all those have conspired to keep the price of gold shares down. And they're the leaders in the industry, and so people look to the leaders, and then you look to the juniors and say, why should I buy a junior if the leaders aren't winning?
Which countries do you feel provide the greatest growth potential for mining?
That's a very good question. It's changing right now. The problem we face is that the price of gold has gone up, and the politicians that granted the licenses, either they've moved on and there are new people there, or they're saying, we gave this property when the price of gold was $300 an ounce. That's our country's asset. We should be getting more out of that. Or we gave that lease on the copper project when it was 60 cents, and now it's over $3. We need more. And so you can go to any country in the world, and they're all thinking they want more from the mineral producers. And the mineral producers are in an uncomfortable position in that not a lot of people in government like them, and they don't employ huge numbers of people. Their operations are far from the urban centers. So it's easy for politicians to say, pay another 10 or 20%. And no one's really going to object, at least in the near term. So Alberta, you would have thought that's considered first world. But they took the revenues on the oil sands from 1% to 5%. Then all these people said, we're not going to invest. And before the Alberta government went back to their original position, said, oh, okay, we didn't mean that, we'll reduce it. The oil market fell off, and all this capital investment was deferred. So what's happening, if you think of investment dollars, I like to think of them as, if you cupped your hand like that and put a bead of mercury in there, if you had science classes, if you flexed your palm, that bead of mercury would find its way through one of your fingers and drop to the table below and break into 100 little spheres. It's very hard to collect and just go off. And investment dollars are very much the same way. So recently, I mean, you have your problem cases in Africa that are always there. You have the Soviet Union that still has more guns than laws, so you could lose things there. But what I'm saying is, it doesn't matter if it's a developed country or a developing country, the politicians are looking to take something. And I would say you should put into your thinking an additional layer of confiscation of 10 to 20% anywhere in the world. But generally speaking, a country with an established law that's been in place and mineral rights is a safer place to be. So North America, South America to a lesser extent. Africa I'd stay away from, and certainly parts of the former Soviet Union, I think I could think of better places to be. So the Americas are a good place to be.
All right, Rob, thank you so much for your time today. Final thoughts for our viewers.
They should listen to Kitco all the time.